Yeah, I know that you probably all saw the most recent SIF trends report, but the what is being identified as ESG grew by 73% over the last report. So it's a biennial report. So 2012 to 2014, they saw 73% growth. Now that's, of course, includes a lot of companies that maybe were not PRI signatories 2 years ago and have since signed and therefore, get classified into that. And I know some folks kind of wring their hands over how pure is that, is it greenwashing, et cetera. From my perspective, it's all good, because it then opens the door. And you talk about talking to your managers. I think that's so important. One thing we did last year was through NEPC, was to ask every one of our managers, we have 15 managers, how do you assess carbon asset risk and how do you incorporate that into your investment approach? And a lot of our managers are just mainstream managers. We give them certain do not buy instructions, but they don't think of themselves that way. Every one of the responses was really thoughtful. Some of them said, we don't think it's a big risk right now, but that was the vast minority. Most of them are really, they listen to the question and they put some real resources into thinking about it. And another quick story I'll just tell you. I'm sure like all of us, I get, calls and emails every day from managers, and I do my best to deflect them, but one day I picked up the phone, and the guy started making his pitch, and I said, well, I just have to tell you that a very high priority for us as a faith-based investor is that you really factor environmental, social, and governance issues into your investment practice. Wow, he said, I'm hearing that a lot lately. So I think we are seeing a real shift. Richard, did you want to comment on that?
I just wanted to follow up a little on something you just mentioned about having a conversation with your managers about incorporating ESG into their daily work, not just screening out. And I don't know if many of you may have seen last year the CIO of the Yale Investment Office, David Swensen, sent a letter to all of their managers, requiring them to, in their research processes, take into consideration global change in their analysis and how that's going to impact their selection of stocks and bonds moving forward. So we thought that was a great idea, and we stole the idea, actually, and we massaged the wording a little and created our own letter, and that's going out to all our managers as well. We're asking them, because by golly, we think about this, we want you to be thinking about it too. We're thinking about the economic impact that's going to occur within these companies, whether it be insurance or industrials or any kind of company, and we want them to be thinking about it too, not just screening out what we're telling them to screen out. We want them to have it embedded in their process. So anyway,
as a manager of public equity and debt who does only separate accounts, we have encountered this among many of our clients looking for ESG integration. But I'm curious, how are you planning to evaluate your managers on that? I know one of the things that we do is suggest ways to evaluate your managers. One thing that we can do is provide a measure of carbon intensity for a given portfolio compared to an index. We can look at emissions intensity, et cetera, and we can demonstrate through our process that we are integrating ESG best-of-class variables in our selection. But how do you think about assessing whether or not your managers are integrating successfully? We're all used to the assessment being investment return, but how are you thinking about that?
You want to try that one?
That's a tough one for us. That's why I think we gravitated toward the private side, because we go into them having definite goals and outcomes we want to see, and kind of measure that as we go, and it's right there in front of us. On the public side, for fixed income and equities, What our approach is to screen out from from the Catholic perspective. So it's not just energy; it would be things in healthcare related and weapons and things like that. And that's a good question. We've never measured to see does our holdings how did that compare to the index, because we use indexes that are not SRI screened, and we spend a lot of time saying that we think we can build portfolios that are screened that does not impair your performance. So we do it, but most of the time, 99% of the time, it's on investment performance. How did we do, knowing that we're at least not investing in things we don't want. But to then say to measure other variables, we haven't gone that far.
I mean, there are some tools to measure carbon footprint of portfolios. I don't know, Richard, have you thought about that?
Well, we have thought about it. We haven't taken that step yet. In our prep call prior to this meeting, one of the questions that Tim posed to us was measurement. How do you all measure impact? And I wrote down, we don't yet. But it is a conversation we have, and these tools are available to measure your portfolio in that regard. But we have not taken that step yet. That's the next step to come.
Sonia Kowal from Zevin Asset Management. So I'm also interested in the question that was asked earlier about how you evaluate if a manager is truly integrating ESG, especially because many of the newer the more mainstream managers that are starting to integrate ESG, integrating ESG necessitates changing your investment strategy, and it will result in different choices being made. And so I'm wondering how, especially consultants, are evaluating that, because you're getting a very different product if you're truly integrating ESG. So that's one question. And then another one is, for those asset owners that are asking their managers to integrate ESG, wouldn't it be great if they also asked them to engage in advocacy also, both on the public policy side and with individual companies as well, because we really could use the help here.
So do you want to ask? Yeah.
Yeah, I'll jump in on the consultant side, and I was almost going to make a similar comment when she had asked her question earlier, which is that it is difficult. There's no really straightforward way to measure impact, especially when you're looking at ESG integration in public equity stocks. That's pretty difficult. And what we hear a lot about, especially as managers, are just signing up to UNPRI on somewhat of a whim in some cases.
Mm-hmm.
You feel like there's probably a lot of this greenwashing going on. And so, again, there's no hard and fast rule, but as we're delving further into this, I think that what we're going to find is just that the answers we get back, especially from managers, frankly, we'll get responses back from managers now across our entire asset base, or manager research database. That's huge. But where we really like the managers, where we're focused on and following the managers that our clients invest with, we're in particular going to ask, I think, more deep dive questions of those and look for specific examples. In some cases, we might conclude that, it just feels like they're not really changing anything meaningful, or there's nothing really changed. I think in other cases, you'll find, some really relevant ways in which mainstream managers need to start thinking about these issues more. And so actually outside of the public markets, I'll mention one example that came up recently, which is that in a private fund, one of the underlying portfolio companies was invested in some luxury brands, including hospitality in Squaw Valley. Now, I can tell you personally, having bought a Squaw Valley ski pass last year, it wasn't a good investment because there was no snow. And on a very realistic basis, we were asking at the firm if this manager had thought about that, and the fact that there's not a lot of snow. There's not a lot of snow again this year, and I did not buy a pass this year, thankfully. But more questions of private managers and public managers that try to delve into how they're thinking about some of these very real risks, I think is what we're going to do more of. And there's no one hard, fast way to do it, but yes, trying to come up with sort of these distinctions between greenwashing and where it feels real is what we can do. And the shareholder advocacy part, I referenced earlier that there's mainstream funds that are going to maybe integrate ESG more, but that I think that the ESG funds that are truly dedicated to this area, what distinguishes a lot of those strategies is our shareholder advocacy, and why for some of our clients that is still what they're going to focus on and be very relevant, because not all managers do that.
Yeah, I don't think they're going to jump into that, but I would have two thoughts. One is, if they're PRI signatories, ask for their report. They have to report every year, so let's look at those reports and question them on it. And on the other side, let's ask for their proxy voting policies and see how are, you know, maybe they're not going to come to this meeting and file a resolution, but how do they vote those proxies?
I wanted to
Well,
pick up
he's
on the
next.
theme that was raised about how to influence one's investment managers. I serve on the General Board of Pensions and Health Benefits of the United Methodist Church, and they have a fairly large pension fund, about $21 billion. And they are very actively asking their managers to do what you said, to share their PRI reports. If they're not a member of PRI, just answer some basic questions. And I'm going to suggest that just asking those questions means a lot right now, even compared to 10 years ago. Jessica would know this. Managers are watching these trends. They're saying, gee, we're getting these questions a lot more. It matters to us. We've got to hone our answers. And the letter that was mentioned earlier by David Swensen of Yale is very notable. It's in the public domain. And he said to their managers, it was lecturing a little bit, you have risk in your portfolio that you haven't identified yet. You need to identify that risk and tell us what you found and protect us. And you have opportunities in your portfolio you haven't identified yet. So this was his attempt to try to address the divestment debate, of course, that's on many campuses, Yale included. But I thought the very fact that it came from him was a very powerful kind of thing. Yeah. So I would encourage Tim, if there's any way to take some lessons from today. There's so many lessons, but one of them should be this point about how do we help ICCR members reach out to their consultants and their portfolio managers and encourage more accountability in this space. And the last one would be not just how are you voting for proxies, what's your PRI report, but please help us in finding some clean trillion investment opportunities. We need your expertise, we need your advice, and you can get some managers thinking about that as our helpmates.
Thank you.